Welcome to Global Asset Allocation and Stock Selection. This is, I guess, an unusual experience for me and I guess for you people too. We've got live right now a webcast operating, and we've got students watching right now scattered all over the world. Actually, I'm not convinced that I've got a student in Australia that they're watching right now, because it's a little out of sync. But what I thought I would do today is to go through the basics of the course, what we're going to do. This is an interactive course in that I expect that you will be asking a lot of questions. And just because we've got cameras here, you shouldn't be shy, okay? Or it's not going to work. I usually do shoot my course just on video, but this is a little different. Let me talk about the webcast just for a few minutes. I sent around a few emails, and just to be clear, webcast students, we handed out a CD-ROM today to the students here, and there's a Federal Express going out. You should get your CD-ROM later on today. So that's all shipped. And the CD-ROM contains basically all of the readings on the list. Plus, I've thrown in some other stuff, like 200 megabytes of data, and also there's this directory called Harvey Other Papers, which is basically everything I've ever written. So it's there. Also, you get my hypertextual finance glossary on the CD-ROM as a bonus. So that's all there. And I find it's a lot easier to be looking at stuff from a CD-ROM rather than downloading it from the internet and maybe printing it. It's a much more efficient way to operate. You should also note that some of the pointers don't work. You might have to actually go to the files and explore and just click on them. And as long as you have Adobe, you should be fine for doing that. Okay, well, let me talk about the webcast a little bit at the beginning, and then launch into the course syllabus. And there are actually a number of things that I need to do today, like the research protocol, and talk about the assignments also, and we'll do all of that. The first thing is that I started out with this idea of a webcast from, actually, I saw an annual general meeting that was webcast, and I thought that was pretty cool. Indeed, they were taking questions by email live during the annual general meeting. And then it just occurred to me that, well, maybe I could do this with this course. Now, why? And it seemed to me that there was an advantage to actually doing this first. And I didn't know of any other business school that had tried to do a course on the internet live. So we went ahead and started getting things going. And then I realized that this isn't just the first course from a business school. It appears to be the first course ever delivered by a webcast. So that's kind of exciting. And a lot of the stuff I kind of learned along the way. I thought it was going to be a simple operation with, we have streaming capability at the business school. Then I quickly learned that that would not deliver high quality video over the internet. Even if we had a farm of computers, what basically you need to make this work is for a firm like Digital Island, which is hosting our webcast. They've set up basically almost a replacement internet. So they pipe directly to key rims around the world this signal. So in Australia, they've got a signal going directly to Australia, and then you get it on the internet there with only a few hops. And the same thing here. We actually, and I didn't know this when we began, we couldn't rely upon the Duke hub to get us to Digital Island, because there'd be many hops to get to their facility. So we had to set up in actually not much time a T1 line to feed directly to Digital Island. So we're not using the internet to get there. And we've got backup satellite capability if the T1 goes down. So it's quite a production. There's a lot of people that have invested a lot of time to make this work. And some of them are in the booth and around here, but many of them are not here. And it has been a real team effort, to say the least. Now, when I started out, I thought I would get a few students. Actually, the model that I proposed to the school, the financial model, was no students. because there's going to be no promotion whatsoever. And I figured that was a good base case to work with so that they could be aware of all the costs and things like that. But it turns out we've had lots of interest, and we've got students, as I said, from all over the world. And we've got students, some of them could be lecturing here. And it's kind of consistent with my original idea for this webcast, that a lot of the students we would pick up are students in kind of senior positions. Well, they're not full-time students right now. They're in senior positions, and they'd kind of like to know what the latest research is on asset allocation coming from business schools. But they can't enroll in a full-time MBA. It doesn't make any sense. It's not feasible for them. Not that they can't afford it. They can certainly afford the money. It's the time. So this is a way for them to pick off some of these ideas in a pretty efficient way. And this is not competing against so-called executive education, where you go in for a 2-hour or 1-day session on asset allocation. This is not like 2 hours or 1 day. This is 24 hours of material. So this is everything. I think that I'm serving a part of the market that hasn't been served before, and so far, so good. Now, what does it mean for you? Because you're bearing some of the cost of this, being here, and I'm going to be saying a few things to the webcast students along the way. I've tried to pull this off in a way that doesn't impinge upon the daytime experience. Okay, so we do have a few cameras here, but and it is different because your questions are being picked up by mics around the room and being broadcast. So it is different, but what you're going to get is that you've got 40 other students in this class that are classmates. And some of these students are at very prominent firms. And some of your fellow students haven't even joined the webcast yet, because we'll have it up in archive version until the end of December. So this course will live on until the end of 2001, until we repost next year. So there's going to be other students potentially. I'm going to post their names on the internet that we can interact with. I'm certainly interested in their opinions on some of the things that I talk about in this course. The other thing that actually didn't occur to me when I set this up was that this whole idea of the webcast should benefit you, not maybe right now, but years down the road. And one thing that I didn't realize is that alumni would be interested in the webcast. Indeed, I've got a person watching right now from California. It's early. Matt Hergott, who took the course 4 years ago. He works at Zurich Scudder Kemper, and he's one of 2 people in this firm that are watching. And he can see the syllabus on the internet and quickly realize that it's changed in 4 years. Indeed, I've made the statement that the half-life of the materials in my course is about 2 years. There's some core materials that don't change, like the research protocol for doing asset allocation research, review of econometrics. That's not going to change. But there's a lot of other stuff that is quite dynamic. So he realizes that this stuff changes, and it might be that he sees that there are 8 lectures out of 12 that are different, and he's going to tune those in. So this is something that I didn't expect. Indeed, when I first pitched the idea at Dean Adams, I wasn't sure what his reaction was going to be, because this is an expensive production to go through Digital Island especially. Okay? His reaction was, this could potentially answer the question that I most commonly get from alumni. And they ask him, when he goes around and talks to them, how can I keep current? And what do we offer? Well, at reunion time, there's refreshers on marketing and finance. Again, it's like 1 or 2 hours. And in terms of the number of people that show up for reunions, not that many. We'd like to have more. We ask a lot of our alumni, but at this point, it's hard to give back. But now we can. So there's a mechanism now for them to keep current through a webcast. The other interesting thing is that a course like this, I chose this course on purpose because it's got a lot of unique content. So it's not just the case that we're getting our own alumni. We're getting alumni from other schools that didn't have the opportunity to take a course like this. Indeed, I challenge all of you to go around the course catalogs at all the top 10 schools and try to find this course. It'd be very difficult to find. And what's the reason? Well, the reason is that the course is very much oriented towards my own research. And in order to get my research published, it's got to be unique. That's, a necessary condition. It's got to be new. Nobody's done it before. So you'll notice that the reading list is heavily biased towards me. Well, that's on purpose. This is, part of what makes this course unique, in that you're seeing my research, some published, some unpublished. And in the past, students have particularly appreciated the unpublished research, because that's the stuff, hopefully, that will become published and kind of standard material in the future. And you get to see it early. You always want information. Information is part of your edge in coming to a school like Duke. So we're, I think, giving you something that potentially could be quite valuable in the future if this is a new model. Now, I also quoted as saying things like, it's better to be, what was the phrase I used? It's better to be on the leading edge rather than pushed over the edge. Like, it's always an advantage to be the first mover, especially on this. And I think that our economic model is a pretty sound model. But like, in a way, what I'm doing is challenging the whole model, the model of the MBA. Indeed, maybe the model in general of education, that you go to a school and you're basically locked into the portfolio of courses that school offers. And that's it. And for you, if you took a course at some other university in their MBA program, we wouldn't count that for credit. And they wouldn't count the course here. So you're locked into that portfolio. So in a way, there's a scenario where highly specialized courses pop up at different schools that are available. So students at other top schools might take this course via webcast. So I'm kind of pushing in that direction. It's a different model, but it basically allows you to diversify your portfolio across different institutions. Though the core would always come from here. Okay, I'm only talking about electives. So there's lots of possibilities here in terms of the future, and indeed I had no idea of the implications. The school has been extremely supportive. I thought that they would just approve, of this. It seemed like a good idea. It's consistent with Duke being on the leading edge of technology. But I didn't know that this would have to go all the way to the president and provost. And they've been very supportive. This is an experiment. We'll see what happens, how it works. And I'll be very interested in your feedback in terms of how it kind of affected the educational experience. And when you actually formulate that feedback at the end of the course, I want you also to think about how this fits for the future, too. Okay, because often, I guess often that's the most important thing. Okay, what value are you going to get out of this for the future? Okay, so that's basically the story. We might have run out of, did we run out of CD-ROMs? We've got a few left. If we do run out, my assistant, Carol Bass, will round up some more CD-ROMs. Okay, any general questions about how this is going to go? No? Okay, good. Well, what I want to do is to talk about the syllabus first, to go through what we're going to do in this course, and in some detail. But we'll also go through assignment number 1 and assignment number 2, and the plan is to talk about research protocol also. So let me do that. It's very important for me to set expectations at the beginning of the course. Everything is available on the internet. So under course materials, you could go to BA 453, and the hyper syllabus is here, and also assignment 1 through assignment 5. The way this course works is, and hopefully you've gone through the syllabus already, you're required to hand in 3 assignments. So assignment number 1, 2, and 5 are required. And basically there's only 2 grades, acceptable and not acceptable. And almost always it's acceptable. Okay? There has to be some hurdle. And then assignment number 3 and 4, those are kind of the extra grade assignments. So if you hand in 3 assignments, you get the P. If you hand in 4, HP, 5, SP, and assuming they're all acceptable. Okay. So in a way, what you're allowed to do is to select the effort that you want to put into the course. So a lot of times people sit here, they know they're not going to be doing global asset allocation for a career, but they want to know basically what's going on. But to do those 5 assignments is a real bear. So what they can do is to select into 3 or 4. And that's fine with me. I keep records of all of this. And if somebody phones me and says, it has never happened before, why is it that student X got only P on your course? I would say, well, actually, let me pull up assignment number 1 and take a look at it, or actually why don't you take a look at it because it's on the internet. And I can say, well, outstanding work for 3 assignments, and that was what the student chose. That's way better than doing mediocre work in 5 assignments, in my opinion. Okay, so you can select the effort, and that is real clear. Just briefly, and I'm going to go back to these assignments. Assignment number 1 is kind of the big assignment, and that's the one that's posted, and you can see some of the history of the assignments that were presented. You actually get to present these assignments in class, broadcast. So you need to start working immediately on that. And it's pretty wide-ranging. We'll talk in more detail about it, but it's something that interests you that kind of fits into the course material. Assignment number 2 you need to get working on pretty quickly. It's due next Monday. And it's actually a lot of work. So you need to get your groups formed and start to get going on that. And it's basically, as I say, I'll go through it in more detail, but it's basically you work with a mean variance optimizer to get one set up in Excel. It's a simple optimizer. And then there's also questions about strategic asset allocation, okay, which we'll talk a bit about today. There's one assignment number 5, that's an individual assignment. And it's just basically 4 questions. If you've been here or watched, like some students have even contacted me saying they couldn't make today's lecture. Well, you've got access to the webcast version, and you can just watch it. And it's simple enough. It's set up at 3 different speeds, so you could even watch at the 56K modem. Okay. Well, let's go through. Any questions on the grading of the course? No? Okay. Well, let's go through the material of the course. And I think what I'll do is, instead of reading it off the internet, go directly to a hard copy. Okay, so what we're going to do later on today is to talk about research protocol and basic econometric tools. Stuff that I know you've done before, but I really want you to understand what's going on, like in a simple regression. So I'm going to go through that today. And we'll do that after the break. Thursday is kind of like a wide open session. And it's about the internet and how it has affected the business of asset management. Okay, so I really want you to be prepared for that, to actually, it's almost like brainstorm what the future is for asset management. We kind of know what's happened. And there's some readings of the past on this for selected articles. These are not as important as you actually thinking what the possibilities actually are. Asset management is also about strategy. Indeed, there's one session that I do on the strategy of asset management. Like strategy in the sense of what you've done in a strategy course. Okay. So you have to have like a business plan. You have to figure out what the competitive environment is, what your advantages are, your weaknesses, and you have to have a vision of the future. It's incredibly important. Vision, in my opinion, is the most important thing. And a lot of what I want to talk about on Thursday is this idea of vision. Where are we going in terms of this, what I consider a structural break, okay, in terms of just everything in terms of our economy. Structural break induced by the internet. And we've seen the beginning of some of the changes, just the beginning. So I will also have a small presentation that I will do on that, but a lot of this, this session is interactive with you. Okay, so come prepared to talk about the internet and asset management. Okay, so that's kind of an interesting session in my opinion. Session number 3 is on strategic asset allocation. Okay. Indeed, this course does basically 5 things. I think you could summarize the course in 5 things. And hopefully some of you have seen the introductory video, the one that was streaming. So basically, in asset allocation, there's 4 or 5 different levels of it. The first one being the simplest, where you just invest in a benchmark. So you want to be in the S&P 500, well, you can buy an index fund for that, or trade the futures. That's it. And you just track the S&P 500. Or you buy, if you're large, you buy all the components. CalPERS, watching right now, it's got $170 billion, and they can't be trading index funds for the S&P 500. They're actually investing in every single stock. So the asset allocation decision is very simple. Though to actually index is a little more difficult than you might think. So you have to worry about stocks going in and out of the S&P 500. That's our example benchmark. And share distributions, buybacks. There's a lot of stuff that you need to keep track of, but it's mechanical stuff. It's very mechanical, and that's kind of the simplest level of asset allocation. The next level is strategic asset allocation, and that's what we talk about on next Monday. Strategic asset allocation is where you are taking strategic, long-term bets that deviate from whatever benchmark you are marked to. Okay. So this involves long-term forecasting. And long-term is usually 5 years. 3 to 5 years is long-term. And indeed, in assignment number 2, there's a question that asks for long-term forecasts. Okay, and we just focused on the S&P 500 to make it simple. And there's lots of data files. Look at the data subdirectory on the CD-ROM. There's lots of data files available. And there's a little bit of updating that's necessary. Also, it says on the syllabus that you need to be familiar with like data stream in the library to get data updates. And it's pretty straightforward to do that. So strategic asset allocation is where you're taking these longer term bets on certain asset classes. And when I say bet, like we're betting right to win. This is not just a random throw of the craps. Okay, so we're going to have support for these bets. And in this course, what we're doing is kind of developing quantitative models to support these bets. Now, the probabilities of winning, it depends on how you look at it. I saw a presentation not too long ago, 6 weeks ago or so, where somebody was saying, well, if you look at all these strategic bets and the tactical bets, which are the next ones, you know, like it seems like half of them just don't pay off. Well, actually, what we want is like more than half of them to pay off. If we're doing 55% or 60%, we're adding value. But it might, if you just look at it and say, well, there's a lot of losers there. That's true. You know, because you can't perfectly forecast what happens in financial markets. So you're going to see a lot of losers. And you hope that some of those losers are due to a low degree of skill. Because those are the people you want to be trading with. Yeah. It's all about information. And I'll talk, about efficient markets also. What does it mean to have markets that are efficient? Now I come from University of Chicago. My dissertation chairman is Eugene F. Fama, the guy that coined the term, efficient market hypothesis. And hopefully by the time you finish this course, you actually understand the concept. And you understand that Eugene F. Fama does not believe that markets are efficient. Efficiency is impossible. It means that prices perfectly and immediately reflect all information. It's just not the case. Efficiency is a relative concept. How fast is the information reflected in the price? And it might bounce around a bit until it gets it right. And all we're trying to do in this course is to try to use some quantitative machinery to be on the right side. This whole idea of what we're going to do. There's going to be a lot of people out there flailing away, literally taking bets that are not calculated. Okay, based upon whatever experience they've got. There's a lot of people doing asset management that are very good. A lot of people doing asset management that, how should I phrase this? Maybe could benefit from the webcast. And hopefully your money isn't with the people that are not signed up for the webcast. So a lot of it is about, there's going to be some errors in terms of pricing. It sounds trivial, but you want to buy low, sell high? That's it, right? You want to identify undervalued assets and buy them and sell them overvalued. That's everything in this course. But we need to figure out how to actually do that, okay, without just so-called seat of the pants asset management. Okay, so strategic asset allocation is the kind of first level of betting, where you're taking longer-term bets on certain asset classes. There's even an issue of what an asset class actually is. We have to talk about that. You can think of U.S. equity as an asset class. And some people think, well, maybe value and growth are two asset classes within U.S. equity. So we have to talk about what an asset class actually is in the course too. So indeed, what we're going to go after in terms of this efficiency, I personally believe that U.S. markets, at least, are reasonably efficient, but there's lots of room to make money. There's some people trading without information, and we're going to have information. Information is the difference. And it's not just the information. It's how you combine different pieces of information together. Indeed, it's even more complicated than that, because you could think of putting weights on different pieces of information and to come up with the best forecast. The weights are going to dynamically change through time. It's got a research paper from the National Bureau of Economic Research, and it's titled something like "When Unemployment is Good News and Bad News for the Stock Market." And I think that's a really good example. It's sometimes the unemployment rate goes up, recently at least, within the last year or so. That's sometimes viewed as good news because it reduces inflationary pressure. And then once you start moving into a recession, unemployment rate going up is bad news because it indicates that the recession is maybe going to be more severe. So it's the same piece of information. And you can think of it as it's going to be useful information in terms of forecasting asset returns. But in a regression context, and I'm going to slip into regression a lot, the coefficient on that variable could change sign depending upon where you are. So this is something really important for this course. And indeed, this is one of the things that I'm kind of known for in terms of my research. It's easy to run a regression of stock returns on lagged unemployment. And you see there's some R squared and you get some forecast. But that model is misspecified just for the reason that I told you. That sometimes the coefficient is positive and sometimes it's negative. And if you just take the average, then you could get into big trouble by using the average coefficient. And unfortunately, some people are swayed by the power of a regression model. Show the regression, fit looks okay, got some R squared, and then you look at in sample, how well it forecasts, and it might look pretty good. And maybe the person you're pitching to really doesn't know regression that well, but knows that it's kind of a high power tool, and what you're saying must be, correct. Not necessarily. So we need to think kind of beyond that. And one thing I really want to emphasize in this course, and I'll talk a little bit about this also, we are at a turning point right now. Right now. We've had great growth since 1990, 1991. And now everything is kind of like weakening. And we're potentially at this turning point in the business cycle. And one thing I know from my research is that once you slip from expansion to slowdown or recession, whatever you want to call it, things change big time. And I'll show you some results today on that. So you need to be thinking about these dynamic kind of models. The other thing that you're challenged to do in terms of the long-term forecasting is in assignment number 2, I asked you to look at a simple regression with the long-term stock returns and the dividend yield. Very interesting analysis, you'll see. And actually what I do is I set it back 1 year. So you're at the end of 1999, forecasting 2000, see how you do, and then update and look forward from today. See how your views might have changed. Now, the other thing I should say, and I'm not going to apologize for this, but I get sidetracked a lot in my lectures. So if it seems like I'm jumping all over the place, that's exactly the case. It's just the way that it goes. Indeed, in the past, I've sometimes completely abandoned what I was going to talk about that day to talk about something else. Now, I really don't have the luxury to do that this time because I'm kind of forced to have a little more structure. So I will talk about all of the lecture topics in order, but there's a lot of room to get sidetracked onto things that I think are kind of important for asset management. So a lot of flexibility is built into this course. Indeed, if there's something that you would like to talk about, I'm very flexible. Send me an email or talk to me. We can work it out in terms of putting it into the course. We can try, at least, to get it into the course. So as I said, it's supposed to be interactive. Now, let me bounce back to one thing that I didn't mention. This is my 6 weeks of teaching, right? So this is all I do, basically, is teach. So I'm available. You know, I do have other constraints, like we're trying to hire more people in finance, so I'll be going to seminars and meeting with candidates. But I'm available. Best to call up to Carol at 7775, or call me directly to see if I'm actually in the office, but I'm available. And indeed, I would like to meet with all the groups regarding assignment number 1. Okay, so once you've got a topic or a couple of topics, come by and we can schedule a time and talk about that. Okay, let's continue because we've got to get through the syllabus by the break at least. The number 4 lecture is on tactical asset allocation, and actually the course used to be called Global Tactical Asset Allocation. And that's all I used to do, was tactical. And I've kind of like broadened the course to add strategic, and I've also added stock selection. So tactical is really what your assignment number 3 and 4 are going to be focused on. I think it's the most exciting part of asset allocation. And you're making short-term forecasts, and what you're doing is you're going to take some calculated bets from the strategic weights. So it could be one sector you're overweighting. So maybe the US equity sector, suppose you're overweighting that right now. You think that it's come down. It hasn't moved very much over the last year and a half. You're going to overweight that, but month to month or quarter to quarter, you can kind of deviate the strategic weight based upon short-term forecasts. And you're going to be building these models in assignment number 3. So you're going to be forecasting returns in assignment number 3. Okay, and these forecasts are going to be used in your tactical asset allocation program. So that's what lecture number 4, and really all we focus on in this lecture is expected returns. Asset allocation includes a lot of stuff. Don't need just returns. You've got to have volatility, covariances, and then stuff even beyond that. But it turns out that the forecasted returns are the most important component. And what we're going to do is we're going to go through a lot of candidate variables that could be useful for forecasting returns. And I'll also talk about this idea of the coefficients on those variables being dynamic and how to make them dynamic in a real simple way. Okay, so I'm going to give you the tools to actually do that. If we've got time today, in terms of review of econometrics, I might even introduce that. Another thing I forgot to mention at the beginning, not only do I kind of wander from topic to topic, I will repeat the same thing many times. And it's not because I've lost my memory. Stuff that I repeat is real important. So I talked today about the efficient market hypothesis. We're going to hear it probably in every single lecture. I'm going to say something about that. Okay, so I want you to really understand that, because it's really critical for winning in global asset allocation. So lecture number 5, we do the second part of tactical, which is co-movement, volatility, and skewness. So basically what we'll do is talk about how to model the correlation between returns. That changes also through time. And we'll talk about volatility modeling. And indeed, I've got a guest lecturer, well, not a guest lecturer, a guest. And his name is Tim Boleslav, and he's a chair professor at Duke economics department. And he is the guy that invented the so-called GARCH model, generalized autoregressive conditional heteroscedasticity. What it means is it's a way to forecast volatility. You do asset management, you need to know GARCH. And you're going to understand it. We're not going to be coding it up to run it in the assignment, but you need to understand the basics. And I'm going to, I think what I'll do is I'll just interview him. And basically, he's got a lot of experience in implementing these volatility models for a number of different firms. And as I said, he's the founder of the methodology. So I think that would be very interesting to hear what he has to say. We also do covariances, because that's important, correlations, and skewness. And I'm going to talk a lot about skewness in this course. Skewness, you know what skewness is? It's often we just work with like normal distributions, right? Bell-shaped distribution. And a skewed distribution is not symmetric. So if the bell is symmetric, then a skewed distribution might have like a really big tail. Okay, and the other side maybe not as big of a tail. So it's asymmetric. And this turns out to be very topical because there's a huge literature out there from both academics and practitioners on things like downside risk. So it's like what you really care about is diversification in the downside, not the upside. Or you want to avoid these disaster scenarios. Okay. So we're going to explicitly talk about skewness because in my opinion, when you talk about asymmetric volatility, which means volatility that is higher when returns are negative, when you talk about semi-variance, which is basically measuring the standard deviation over negative returns and measuring it over positive returns. So you get two different measures. When you talk about jump risk, usually jump down risk. When you talk about downside risk, all of these things to me mean skewness. And I've got a preference over skewness. I like positive skewness, which means the big positive payoff, and I don't like negative skewness. Now, it's kind of interesting that the standard finance textbooks that you open, actually, notice there's no textbook in this course. Well, this is one of the reasons. Like you've done the intro course, maybe some of you have done the investment course, but everything is in terms of mean and variance. And that's it. The efficient frontier, that's the other thing we're going to draw a lot. Like I know you all kind of know the efficient frontier, but you don't really know it. Indeed, I didn't know it until kind of like 5 years after my PhD. Didn't really understand it. So I understood it mechanically, but to really understand what it means takes a lot of thought. And I'm going to try to convey those thoughts to you. It'll be a lot more efficient for you than it was for me. So everything is in terms of means and variance, and it stops there. It's like our asset pricing models that we often use, capital asset pricing model. One way to get that asset pricing model is to assume normal distributions, that everything is in terms of mean and variance. Risk is beta. And what beta means is the contribution of the asset to the variance of the well-diversified portfolio. Well, what about the downside? What about this tail behavior, extreme values? It's assumed away in the standard model. So one thing I want to push is this idea of looking at more than just the mean and the variance. Now, I don't want to preempt too much of what I'll do, but I fundamentally believe that people have preferences over skewness. I believe everybody here has a preference over skewness, which are basically the same as my preferences. explains a lot of stuff. You know, for years, people couldn't explain, you know, why people go out and buy lottery tickets. Like, what's the deal? The expected payoff of a lottery ticket is roughly, for $1 paid, expected value is about 48 cents. So it's got a huge negative expected return. So why are people paying the money? Like, if it returned the treasury bill rate, then it would be priced at 47 cents, 46 cents. So people paying $1 seems overpriced. Well, it's not overpriced because people have this really strong preference for positive skew, and this is a great way to get it. So it's a big payoff in the future. Or a more practical example, because most of us aren't buying lottery tickets, why is it the case that the S&P 100 put option out of the money has a really high implied volatility? I mean, people talk about volatility, smirk or smile and stuff like that. Well, to me, it's real clear. Because when you buy that put, it provides a natural type of insurance for your portfolio. The market goes down, that put pays off. And effectively, what you're doing is reducing the amount of negative skew in your portfolio. And you're willing to pay for that. You're willing to pay. And that drives the volatility up. It's a perfect instrument to actually reduce negative skewness. Price of the option goes up, the implied volatility appears higher than you would expect. So all of this is skewness, and everybody is implementing these models with downside risk and semi-variance. Well, basically what we're going to do is think of a three-dimensional representation. Okay, so we got the efficient frontier is two-dimensional. We're going to push it to three and assume that people have preferences over skew. This is a fairly new idea. Indeed, I just published a paper in June 2000 on conditional skewness and asset pricing. But we'll talk about that a fair bit. Indeed, it's more complicated than that. It goes beyond skewness. Do you know what's beyond skew? Kurtosis. And that is kind of measuring the fatness of the tails. It's like the risk control that was going on at LTCM in 1998. They claimed that the event, in terms of their value at risk analysis, was like 10 sigma event. 10 sigma is, actually I should work that out. I think it's like once every 3 billion years, which didn't seem to me to be that extraordinary in August 1998. So Russians defaulted on some of their short-term debt. It's not 10 sigma. It's 10 sigma maybe according to a normal distribution. But given the sort of bets that they had on, the distribution of payoffs was highly skewed. It wasn't 10 sigma. So it's especially, and we talk about asset management and how to invest your money, but it's also important how to control the risk. And a lot of these value at risk models are really naive in that they assume multivariate normal distributions. That's a mistake, a real mistake. Okay, the lecture number 6 is on asset pricing and asset allocation. So basically what I want to do is I want to talk about, and this is kind of related to the risk of the portfolio and the allocation of the portfolio. I want to go through the type of models that help us figure out what the expected return should be given the risk exposure. And I'll go through all of the kind of latest models, and it's kind of, I think, particularly interesting because there's a large number of models out there, and people really don't know what to do in terms of evaluating risk. So just a practical example. Somebody is an asset manager, and they achieve, let's say, 5% above their benchmark. So it's good news that you beat the benchmark, but you need to know what sort of risk the manager was taking to do that. So maybe the risk that they took was much different than the risk of the actual benchmark. And it might be real hard to see. So it could be an equity manager that if you looked at their returns and compared them to the benchmark, let's say it was S&P 500, over the year they might have a beta of exactly 1. So beta of 1, they say, well, look, we're benchmarked the S&P 500. But it turns out that even though that beta is 1, they could have a lot of other risks going on in their portfolio that isn't captured by simple comparison of their portfolio in the S&P 500. So that type of performance evaluation where you just evaluate against the benchmark or against one factor, I think is very naive, and it's easily gamed. Indeed, a lot of students find that this lecture is quite useful because it shows them how to kind of, I don't want to use the word beat, but exceed a benchmark. Right? And it's really no big deal that you're doing, you're just taking extra risk. And the ideal situation, I guess, and maybe I shouldn't be recommending this kind of like live and across the world, but the ideal situation is that you're being evaluated by somebody that's got kind of like a naive set of evaluation tools. They believe risk is captured in only one factor. Well, then all you need to do is to neutralize that one factor and load up on the other factors. And you know how these payoffs work. If you do great, then you're rich, and if you don't do great, then the worst that could happen is that you're fired and you find another job managing maybe less money. But really what I want to show you is the way to evaluate that. If you were actually looking at somebody's performance, you should be able to sniff this out pretty easily. Okay, because I'm going to talk about more than a single factor model, talk about multi-factor model, and it's particularly useful for performance evaluation. Lecture number 7 has to do with attributes in asset pricing. And what that is we'll actually look at firm-specific attributes and see how they kind of play into the asset pricing puzzle. And I've got specific ideas on this, and indeed you see that I've got a number of publications on this particular idea, plus some ideas that are not published. Number 8 is a lecture that I added this year. Well, actually, I've added about 4 things this year, but this is one of them. And I want to talk about fixed income and equity. Most of this course is focused on equity, but obviously fixed income is really important too. And I've got a really interesting asset management strategy case. I've moderated this case before, and it is kind of a firm trying to figure out what to do in the future, and they're kind of meeting at a retreat in Whistler, British Columbia. And I think it's quite cool, and we're going to divide the class up into the different groups kind of associated within this case, and talk about strategy, asset management strategy. So this is a firm that mainly deals with fixed income, but they're considering maybe broadening to equity as well as fixed income. Okay, then we move into screening and selection. Okay, so really, the end of the course is focused on stock selection. So again, I've added this material, and we're going to be doing some real live selection exercises, some material that I actually was engaged to set up a stock selection model for a large, well-known asset management firm. And basically, I'm going to show you the spreadsheets. They said that it was OK. So the internal workings of an exercise that actually goes through and identifies the best stocks and the worst stocks. The goal of this is mainly to figure out some sort of long-short program. You buy some stocks, you sell some stocks, and you're roughly market neutral. Okay, so We'll go through that in a lot of detail. I've got lots of ideas as to how to do that. And indeed, the expertise in the market is really disparate. So you've got some people that are selecting stocks just based upon some recommendation of a financial analyst, and that's their model. And you've got some people running quantitative programs. Often some of these programs are really naive too. Well, they're operating, for example, a dividend discount model, which all of you know from intro course. You know, the Gordon growth model. Yeah. But that's it, one factor. You know, billions of dollars being allocated on one factor. That to me makes no sense whatsoever. So we're going to talk about multi-factor models here, multiple attributes. Okay. Indeed, dividends are really crazy in the US. 85% of the firms in the US don't pay dividends. 85%. So just to use that one variable, that's another variable. We're going to find in assignment number 2 that its interpretation has changed through time. Okay? And it depends upon where exactly you are. So we're going to go through the different ways to develop these stock selection programs. We're going to talk about basic screening. And the type of model that I put together is a highly quantitative model that effectively does the work of thousands of financial analysts. Indeed, maybe that's not a job I would recommend for the long term. Okay? There is a role for financial analysts in that actual model, because they look over the final selection. And maybe they got some information that we're not incorporating into the model. But it's a role for a small number of experts. And that's maybe something I should mention that's kind of important. We're going to be developing a lot of quantitative models in this course, but they're models. And models are simplifications of reality. And they're wrong. And you need to recognize that. So, you know, a lot of the skill is when to override. Okay, when your model's saying something and you know it doesn't make sense, and you override. Okay? And you really need to understand the model. I'm not just going to give you some quantitative model saying just like press the button. No way. You got to understand everything that goes into these models. And you need to understand where the weaknesses are too. And that's a real skill. It's like asset allocation. I know it sounds a little corny, but there is an art to asset allocation. It's not all science. You have to be very innovative. You have to look at things that people wouldn't usually look at. You have to do stuff that's different to maintain your edge. You have to have the next generation of models being developed even while you're running your own model. Research is very important. Computing power is very important. And just to set the model up and to understand it is, you know, a very significant skill. Now, probably not many of you have econometric degrees. Like I doubt anybody specialized in econometrics undergrad. And you see, well, there's a lot of, you know, people out there with PhDs in physics and econometrics, like doing the actual modeling, these quantitative models. In my opinion, you don't need that. What you need is the intuition as to what's important, how these coefficients should change through time, and the actual running of the models you might want to delegate to somebody, one of the rocket scientists. That's fine. But you need to understand what's going on. So there's no black boxes in this course. You need to understand the model. You need to be able to build the framework yourself. And you can do that after this course. The actual implementation, simulations and stuff like that, I would delegate. I do delegate that kind of stuff. Okay? But it's kind of like a higher level, you know, that I think is really important. We're going to try to squeeze that out in 6 weeks. It's a lot to ask. There's not much time. And that's basically it for the actual course. I do have this session on hedge fund strategies, and I introduced there what I call kind of a high-frequency tactical asset allocation program, because it's very popular these days to actually operate within the day. So tech data is easily available, and there's a lot of people doing forecasting within the day. You need to be aware of that, and I'm going to show you some results of models. And indeed, I'm going to describe one of the models that I developed based upon the theory of entropy coding. And it's a paper that's on the reading list. It's an incredibly difficult paper to understand, but given that I have to pitch it outside, I believe that it shouldn't be any problem for people to understand the basic intuition of what goes on in that high-frequency model. So we're going to go through that so you understand it. There's a lot of stuff out there. You know, these people that are doing asset management, they get, you know, like 20 mailings a day with people with some new model, some neural net or genetic algorithm, whatever wavelet model. There's a lot of junk. Okay, a lot, and you have to be able to sift through it, figure out what's good and what isn't good. And part of the way we're going to do that is to develop kind of a research protocol. Okay, so let's take a 15-minute break. Nobody said anything yet, right? So you have to start speaking after we come back from the break. And I'll go through some slides that I've got on kind of where we are in the business cycle and talk a bit about assignment 1. Maybe you could talk about assignment 1 too, as to what interesting topic might be for that assignment. Okay? Okay. So what I'd like to do is to talk a bit about the general strategy of asset management, why this stuff is important. And we'll go through, I guess, some of the assignments. And first, are there any questions? Nobody said anything yet in the course. And I'm advertising this as an interactive course. So there's got to be some interactivity. Any questions about where we're going in the course? Anything that is not on the syllabus that you think I should cover? No? I've covered everything? It's hard to believe. But we'll think about that. Yes?
Are we going to do anything that's going to be internationally oriented in terms of asset management?
Indeed, everything is internationally oriented. I might use the example of the S&P 500 a lot, just because it's simple and because it's a large proportion of the world. And not only that, it has a huge, the US has a huge influence on international investment. So it is true that we're a bit skewed towards the US, but for a good reason. Indeed, let's go to this PowerPoint slide. And take a look at this. I think this is just a dramatic answer to your question, why are we kind of US biased in this course? And the PowerPoint slide is basically, what I've done is I've taken international returns, the countries are along there, the very last bar is the world, okay, a diversified world portfolio. And I've done an incredibly simple exercise. What I've done is I've sampled the returns during an official US recession. Okay, so that's peak to trough, according to the National Bureau of Economic Research. I've taken all of those recessions from 1970, and then simply all of those months took the average return in US dollars for all these different markets. And then that's in green. In blue are the returns from the expansions. So all the dates that are not recessions, all the months that are not recessions, I'll call expansion. And then just take average returns. So this is an exercise. Don't need regression to do this exercise. Just need a spreadsheet, and you need the National Bureau of Economic Research dates. And the results, I think, are dramatic. Take a look at the US. Now, it's true that returns are lower in recession than they are in expansion. But US does pretty well compared to the rest of the world. This is showing that the US business cycle has a dramatic impact on equity markets around the world. And some countries really are punished during a US recession and really benefit during expansions. Now, take a look at Hong Kong, for example. So it is true that if we look at the macroeconomics of this, that the US share of world GDP has decreased. But as the world becomes more open with trading, the US's influence is, well, the data speaks for itself. People can say, oh, well, the US is a really powerful nation. Well, whatever. Let's look at the data. And the data suggests that the US business cycle has a dramatic effect on returns. Now, remember I said that this is kind of, for the first time in like 9 years of teaching this course, we could be at this turning point in the business cycle. It's been a long time since I've been able to show some of these graphs. So this is something you need to think about. Okay, this says something about tactical asset allocation and maybe strategic asset allocation also. Okay. Now, there's one thing that we need to figure out here that's kind of important, and that is that what are these NBER business cycles? Okay, so how are they actually established? Because this seems really powerful. Okay, but they date the recessions and expansions after the peaks and the troughs. Okay, and that turns out to be important because this is not a variable that is in our information set today for forecasting. Okay, let me give you an example, a tangible example. The election, Clinton versus Bush. Is that November 1991? Is that correct? 92? 92. And one of the major issues in that election was the state of the economy. Okay, and President Bush at that time basically said that the recession was over. And candidate Clinton at the time was saying, we're in deep recession, you're out of touch with reality. Now, I actually went on the record saying the recession was over. And I was branded just a mouthpiece of the Republicans, which, but it was according to my research. And it turned out that after the election was over, that the National Bureau of Economic Research assigned the end of the recession to, I think it was July 1991, well before the election. Okay, so they take some time to actually assign the peaks and troughs. So this is not the type of information that we could use directly for forecasting returns. This is interesting information because it says the business cycle in the US is hugely important for asset management. Okay? We just cannot afford to ignore this. Indeed, this is a graph that I kind of show at conferences, but I've never published. So it's kind of interesting to look at that. It's very consistent. There's, when you're doing forecasting, there's always like false signals. You always get some of them wrong. Remember what I said, 55% be pretty pleased with? 60%, 65 is great. Well, in this analysis, every single country I looked at had the same story. And while it's true these countries are correlated, the amount of correlation between these equity returns is not as much as you would think. On average, maybe 40% correlation. Okay, so that's the expected returns. Well, let's look at volatility. I think volatility is next. Standard deviation. Again, in green are the recessions. In blue are the actual contractions. Okay, how many of you took Magnus's investment course? So you've seen some of these graphs. I gave him these graphs. So basically the story here is in recessions, in US recessions, returns are more volatile. Again, this impacts what we do in asset management because volatility is an input into the investment decision. Our portfolio weights depend upon volatility. Okay, so it's clear here, well, it's not perfect like it was with the returns because there's a few countries, Sweden and Austria, where volatility is a little higher during expansions. It's not perfect, but it's pretty clear that volatility is higher in bad times. And maybe this is something you would expect because you think volatility, and a lot of what we are going to do in this course are, here's a forecast of volatility, but what does it mean? Like, why does this graph look like it looks? And one simple way to understand what's going on is that in a time of recession, returns are lower. We saw that in the previous graph. Well, that has an immediate effect on the firm's capital structure. If the value of the equity goes down, then the debt-equity ratio goes up. Effectively, your market leverage increases. Your leverage increases, you're riskier. It's an option that's more out of the money. And that should be translated into volatility. So this is like no surprise that volatility is higher during recession. And one thing, just from this simple analysis, when you get out and you're doing your asset management, you need to make sure that the models that your company is using takes this into account. That there's a difference between doing your asset allocation during an expansion and a recession. Okay, so volatility. The next one, I think, is either covariance or correlation. Before we actually look at that one, let's kind of think about what it should look like. So everybody remembers the formula for correlation? Formula for correlation is the covariance divided by the product of the standard deviations. Remember from intro finance? What happens to the product of those standard deviations? It increases. When that increases, what happens to correlation? It should decrease. So in a recession, if standard deviations increase, you would expect the correlations to actually decrease if nothing happens to the covariance. Right? So the volatility effect is pushing, is actually increasing the denominator, which overall should reduce the measure of correlation. And I think I've got correlation here. I might just have the covariance. But it turns out that intuition is wrong. Check out the correlations. Correlations are higher in recession. So even though the volatility is increasing, which should increase the denominator and decrease the correlations are higher in recession. Exactly the opposite of what you would expect from that simple formula. Okay, so let's make sure we got this right. The correlation is defined as the covariance divided by the product of the standard deviations. We know that the product of the standard deviations increases during a recession. And that should overall decrease correlations in a recession. But what we see is an increase in correlations. Exactly the opposite of what you would expect. And the key here is the covariance. Obviously, the covariance is changing. And hopefully I've got that next. Covariance is actually the thing that goes into our asset allocation model. And it is dramatically different from expansion to recession. So covariances are higher in recession. Okay, again, let's step back. You've seen the data. What does it mean? Like, who cares if the covariances are higher in recession? Well, I'll tell you exactly what I think it means. You actually go and hear these presentations. Oh, you should diversify your portfolio internationally. Well, why should I do that? Well, diversification means that if the US is having some hard times, then your diversified portfolio will benefit from good times potentially in other markets. That's the idea of diversification, kind of risk reduction. So it protects you in the downside. Okay? So ideally, what you want here is when the US is having some bad times, if you're a US-based investor, you want negative correlation. Right? So the US is doing poorly, some other market is doing great. That's really what you want. But the data suggests something much different. It says that when the US is in recession, the correlations increase. And that is exactly what you don't want, because you're not getting the intended diversification benefit. So another way to look at it is the following, and I'll construct just a few examples. Yes, Tom?
Couldn't you have some benefit from having the other market go down less than the US market, though?
Yes. And in the correlation, that's possible, but when we actually saw the results in the first slide, it looked like a lot of these markets go down more than the US, right? So there is a benefit. I agree that if the US drops 20%, maybe it's a good thing that some market only drops 5%. So you do get some benefit in terms of diversification. But the benefit is not exactly what's being sold, and that's my point. That if you just look at all of the data, so instead of having 2 bars, I've just got 1 bar, okay, looking at all of the data, then what you actually see is, I said that the average correlation with the US is, let's say, 40%. Well, if we sample by recession and expansion, then what we actually get is a higher correlation in recession. This is not exact, but for the purposes of exposition, suppose it's 60%. And then in expansion, it's lower. Let's say it's 20%. So you go in with this expectation of 40% correlation. And then you hit the recession. US returns start to go down. But you notice that your international portfolio is not delivering the diversification because it's dropping with the US. Indeed, the correlation is not 40%, it's 60%. And it's like a bad surprise for you that everything is moving so closely with the US during a recession. So that's kind of like a bad outcome. And it's also the case on the other side, that if the US is in expansion, you say, well, this is great, because I know I got 40% correlation with these other markets. But you don't. It's actually 20%. So US is doing well, and the other markets aren't doing as well as the US. So you're disappointed again. You expect 40, and then on the downside, it goes up to 60, which means you're not diversified as well. And then when you want things to move together, they don't move together the way they want, the way you want them to. Yes?
Is there ever a reason to invest internationally, then?
Yes. There's definitely a reason. And that is that you need to be able to figure out how these correlations actually change. And it might be that you start tilting towards markets that have less exposure than some of the ones that are plummeting during U.S. recession. So I showed you Hong Kong as an example of a market that really drops when the U.S. is taking a hit. So again, you might want to change the way that you allocate to retain that 40% correlation. Okay, so there is a reason for this course in global asset management. Absolutely. But the thing that I'm trying to emphasize here is that you can be oversold, you can be fooled, because people haven't thought through this simple exercise. Again, this is not rocket science. It's a matter of pulling off the dates of the recessions from the NBER webpage. And you can see that there's a dramatic difference. This, to me, implies that you need to take this into account in asset management. Okay, so, but one problem here is that you don't really know, but we actually don't know where we are right now in the business cycle. I said that we're at a turning point. I believe we're at a turning point. It could be that the NBER in a year from now dates the peak of the business cycle in the summer before the election. That's a possibility. And it could be that we're entering a slowdown or recession. Don't really know. But one thing that we do know is that the business cycle is somewhat persistent. So if it's clear we're in expansion, then most likely next quarter we're also in expansion. It doesn't change that quickly. The turning points are a little hard to realize, but we might actually have some ability to forecast those also. Okay, so the terminology here is persistent, and persistent means predictable. Okay, we're also going to argue that equity returns measured over long horizons are somewhat persistent, or mean reverted. Okay, and that's going to be important for our long-term forecasts. So really what I'm challenging you to do, see two things right now. The first is you need to realize right off the top that the traditional way of doing portfolio optimization is going to be a real problem. Okay? Instead of having two bars here, if we just had one bar and just use that in our optimization, that's going to produce disappointing results, because this is a major factor that's being ignored. That's the first thing. And the second thing is that we need to think about the business cycle as kind of like a fundamental factor, kind of driving things in the economy. And think about whether there's a possibility of forecasting that. Okay, because while it's important to distinguish the differences here between recession and expansion, it's also important to realize that this is not something that I can forecast ex ante or looking forward, because the NBER is slow in actually deciding where the peak and the trough is. So this is not a forecasting model. We need to do something else to make it a forecasting model. Indeed, what we have to do is to forecast the turning points of the business cycle. So suppose we think about that. And I always haven't put this graph up in a while, but some of you might have seen it in one of the earlier courses. This is a graph of basically my dissertation at the University of Chicago in 1986. Okay, this is a graph of the US economy, real GDP growth on an annual basis, and the difference between long-term and short-term interest rates. So I always have to give a plug to my thesis. But what my thesis showed at the University of Chicago was that there was a relationship between the slope of the yield curve, or the difference between long rates and short rates, and future economic activity. And there was a lot of economic machinery in it in terms of asset pricing models and a lot of economic intuition for that. But mainly what I did was to use historical data going much before 1969, actually going back to the 1870s, to show that there was a relation between the slope of the yield curve today and movements in the business cycle in the future. So take a look at that graph. And I've just graphed from 1969 through today. But the remarkable thing here is that every time that blue line goes below 0, which means that short-term rates are higher than long-term rates, every time that happens, a recession follows. There are no false signals. Now, I made some disparaging remark earlier about people doing asset management based upon one variable, the dividend yield or something like that. Well, you know, how far can you go with one variable? Here. This is simple data. It's available every day for free. And actually, what I'm using here is a 5-year Treasury bond minus a 3-month Treasury bill. Just looking at that spread and seeing what it actually says about the future. Now, my dissertation, the data in my dissertation ended in 1985. And I was called upon to make some out-of-sample forecasts. For example, October 1987, stock market plummets. And the consensus amongst economists was that the economy would go into recession in 1988. Indeed, I remember a forum that we had in Janine. And I was stuck on as the most junior professor. I was last. And everybody's drawing all these graphs. Actually, future Dean Breeden was also making a presentation. I think he probably remembers this one. Because it was a really interesting graph he put up. He looked at annual returns of a market against GDP the next year. And it looked like, according to his graph, that we're headed for recession. And he was not alone. So if you look at the survey of economists, a huge number thought, with a shock like we had in October 1987, that's going to translate into a recession. So I was last, as I said, well, you know, I got to go with my dissertation. And you kind of see the data around 1987 suggests robust growth in 1988. Indeed, I said, well, you know, I was apologizing for the forecast of like 4% real growth in 1988. But, you know, I had to go with the model, right? I'd invested all this time as a student, and this was the time where you go out of sample. Indeed, some people have criticized me because my exercise really wasn't an out-of-sample exercise. Well, here's an opportunity, 87. So 87, you can see from the graph also, was robust growth. It was about 4% growth. So that worked. And the next time I had to go on the record was in 1989, beginning in 1989. And the yield curve inverted for 3/4. So I went on the record. It was like a real, New York Times did 5 articles on this, what the yield curve was saying. And it was saying recession, and it was saying it was going to last for 3/4. And I said it was going to begin in 5/4, and the recession began in 5/4. It lasted for 3/4. And the only thing that this didn't tell us was the depth of the recession. So my model suggested it would be mild, and it was deeper than that. And I've already told you what happened during the election, the Clinton-Bush election, where the model had a positive slope. The recession was over as far as I could tell. But people chose to ignore my dissertation research and say that it was a political statement. Really, it wasn't. Yes?
Could you talk a little bit about the intuition behind it?
Yeah, it's an intuition, and I don't want to get too sidetracked on this. But it's an intuition that basically has to do with hedging. In all of our economic models, people want to smooth their consumption. So You don't want like hugely volatile changes in your consumption. So if it's really good time for you, you'll tend to save some for the bad times to hedge yourself. It's kind of natural sort of hedging. People are risk averse. And one mechanism to actually do that, and the example I give is kind of a longer term bond and a shorter term bond. We could think of it as 1 year. You expect a recession next year. So then what you would be doing would be to kind of transfer out of cash and buy this 1 year bond. Okay? What happens when everybody starts to buy this 1 year bond or 2 year bond? Price goes up, yield goes down. So this kind of natural consumption smoothing causes the shape of the yield curve to change. And you put that together, and what basically happens is that you pick up in a very efficient way kind of what expectations are of the future by people's actions today. Now, it could be other stuff going on. Like right now, what's really complicated is that the Treasury is buying back a lot of long-term debt. But it's maybe not that important for my model because I'm using 5-year, and a lot of that action is out in the longer term. Yes?
Does that mean you're going on record now for the world predicting a recession?
I guess, what can you do, right? You have to stand by your model. Thank you for that question. Yeah, absolutely. And there is, you can make the argument that there has been potentially a structural situation with a new government coming in, and we'll have to see how they actually handle some things. Indeed, look at the recent behavior of the yield curve. So I think that is a real qualification because some dramatic changes could happen that maybe take us off the course of recession. So yes.
Are these Fed buybacks then, is that a major factor in this?
In this graph, I don't think so because I'm using the 5-year bond. So that's my long-term bond. But it's pretty clear, we're heading down. We have started to see GDP go down. And actually think of other stuff. Like, remember I said that there's only one variable? There's other stuff that you can look at. And the other stuff that is kind of classic indicators, like the price of oil, like that's associated with like 4 of the last 5 recessions. And the price of oil today is pretty high. Okay, so that's a major factor, I think. You look at credit spreads, and credit spreads are pretty high. You look at consumer confidence, and we've seen a string of decreases in consumer confidence. So all of this kind of together suggests that we're kind of on the course for a slowdown. And the other thing that's real hard to quantify, and that is that we've been in expansion for so long. Like, do you believe that we've ended the business cycle? I don't know. Yes?
In this particular expansion in the last 5 years, we have seen a lot of productivity improvement, which probably wasn't there in the previous expansions. Did you make any changes to your model to account for any of the new economy things in the last 8 years?
No. And that's a valid criticism, that maybe the coefficients have changed. I have not tried to model that, even though I preach that in this course of changing coefficients, structural change. I've not done that. So it is indeed possible that given some of these structural changes, the productivity, that the volatility of the business cycle is decreased. Indeed, this is very difficult to quantify because we don't have any data. You could tell the story that the US business cycle has become less volatile. And it's a reasonably convincing story. Like now we're trading more with the world, which provides some natural diversification of the economy, whereas before it was all internal. And indeed, the size of the trade sector in the US is pretty small compared to some other countries. Hong Kong, for example, is a massive trade sector. Exports plus imports much larger than their GDP. So there are other factors here. And remember what I said at the first part. This is a model. This is not a perfect model, but it gives us something to go on. Okay? And one thing that's really important here is that this provides some ability to forecast. Okay, so this is telling us about a turning point before the turning point happens. Okay? And kind of the way I view this And the way that I want you to view this is you should be thinking, what does this mean for asset management? I was at a conference in Copenhagen in December, and I rolled off the plane at 8 a.m. and began speaking at 9. I was shocked by the number of people there too. It's like 120 people, like waiting for my taxi cab to arrive. And I showed these graphs, the first 5 graphs. And that was it. That's all I had was 5 graphs. And then somebody in the crowd said, well, this is useful, but what does this mean for my asset allocation? What does this mean for stock returns? Like you showed me that stock returns are higher during expansion, lower during recession. But you also told me that you can't really use that because you're not 100% sure where you are in the business cycle. Now you show me something that here's a variable, it's known today, that kind of forecasts with a fair degree of accuracy what's happening in the business cycle. So what's the missing slide here? Any ideas? People were asking for the slide. I wanted to pull out my computer and do the slide for them right there, but I knew that wouldn't work. Make a mistake, or I wasn't thinking too clearly also after a long flight. How can this be useful for asset management? The yield curve forecasts the state of the business cycle. Well, we're not investing in the business cycle, right? How can we translate this into something that helps us in asset management? Yeah?
Just find what asset classes do best in a recession?
Well, we've kind of done that with countries, right? So there's data there, so we know, for example, Hong Kong does terribly during the US recession. So we can kind of see which countries kind of do the best. And I could do the same graph for asset classes. Let's say we got all that information. So we know which asset classes do the best in recession, worst in, for all the business cycle situations. So what do we do with this? How do we know where we are in the business cycle? This can help us, right? Yeah, Prakash?
You change the covariance if you're entering into a recession so that you get new asset allocation.
Okay, so you're saying we're going to change the inputs to the model for asset allocation based upon kind of where you think you are. And what's going to help you establish where you are? This. Exactly. So now we can have kind of a model, and I'm not suggesting this, what I call univariate model, like one variable model. This is just an example to show you that the business cycle is predictable. It is really important for this course. If the business cycle is predictable, that means that the equity returns should also be somewhat predictable. So the graph that these people actually wanted, hopefully is here. That's not it, but this is just another summary. It shows economic growth after yield curve inversions and all the other quarters. That's pretty dramatic. And this is just in the US. This is the graph. This is what they wanted to see. So all I did here was to sample the returns 1 month after a yield curve inversion. Okay, so if the yield curve inverts in June of 2000, then I take a look at returns in July of 2000. So it's always one ahead. And look at the difference between the returns. This is not perfect. Notice that there's one country, 2 countries at least, that the returns are higher during inversions. But almost everywhere else, the returns of these equity markets are much lower when there's a yield curve inversion. So this is kind of draws the circle to a close. So we know that the business cycle impacts the stock returns. We know the yield curve tells us something about the future business cycle. And therefore, the yield curve should tell us something about the future equity returns. And that's exactly what we see here. So this is an example of a single variable, the slope of the US yield curve, having a very dramatic impact on global equity returns. Okay, now the key thing here is that this is a single variable. There's going to be other things that are also forward-looking that we're going to want to look at. And indeed, I would like you to really think about this graph. It's a very simple forecasting model. Very simple. It's basically what it says if we look at the US, for example. And these are monthly returns. It says that if you're in the normal shape of the yield curve, then your forecast is about 1.2% per month. And if the yield curve is inverted, then your forecast is, let's say, 0.3% per month. And that's it. So you just get two forecasts from this model. It's kind of like a regression model, but it only provides two forecasts, but two incredibly important forecasts. Now, there's going to be a lot of errors from that forecast, but if you get it right over the longer term here, or even the medium term, your performance is going to look very good. The other way to actually do this is to use a regression type of forecasting model. And in that model, we would have the equity return, and we would regress on the lagged, one period before, slope of the yield curve. And some of you are actually going to do that in assignment number 3. And one thing that you're going to find is, so you do that, you might get a significant coefficient on the yield curve, but it's not going to be that dramatic. So you're going to fit the data from 1970. I've given you all the data. It's all on the CD-ROM, and you can update it from data stream. You're going to run a regression in the lagged yield curve, and it's going to be significant, maybe. Very low R squared. So what's the story there? How can this be so dramatic in terms of distinguishing positive and negative returns? This is the kind of value-weighted and equally weighted world returns after an inversion and during the normal slope of the yield curve. Hugely different returns. So what's the story if I actually, you've done regression before. If I actually do a regression of the stock return in whatever country on the lagged US yield curve, it's like marginally significant. Yet we get this. So what's going on? Any ideas as to why the regression, which is kind of like the standard tool for forecasting, the regression is going to deliver kind of a weak relationship. But looking at this, it's way stronger than it would seem. Yes?
Because of what you kind of mentioned at the beginning, that you have two states of the world and you're capturing the average in the regression.
That's exactly right. So it's like you're fitting one bar. Okay. So a possibility here would be to split up the different states and estimate two regressions. That's a possibility. So there's one regression for negatively sloped yield curves and another regression for positively sloped. That might help. There's other things that we can think of doing. But that's the sort of stuff that you need to really think about. This is incredibly simple, but very powerful. people will present. People might say, well, you know, this variable, yeah, we know about Harvey's dissertation, blah, 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 but it just doesn't work in predicting stock returns. And here's a regression, t-statistic 1.8, it's gone. Now, the key for you people is to know more about kind of the intuition of a regression model than the person making that presentation. That person might have a PhD in statistics, but doesn't really understand that this is a classic example of a misspecified regression. And this is evidence that stuff changes through time. Now, most of what you're going to do, there's a big however here, in assignment number 3, where you're actually doing some of these forecasts, you're going to be fitting in sample. I'm going to be telling you a lot about why that's potentially problematic, but to get kind of up to speed, we're going to have to be fitting in sample with one coefficient. We'll experiment a bit with time-varying coefficients, but most of the time, we're going to be fitting in sample. Okay, but we need to go kind of beyond. What I'm challenging you to do, and the stakes are incredibly high here. This is not like, well, I might get into trouble giving some examples here. There's a lot of dough on the line here to get this right. Okay, the firm that you're working for, your personal investment account, and to make these decisions, to make these bets, these tactical bets, it's a lot on the line. And indeed, if you actually look at the performance of asset managers, and there's a number of studies that actually show that the performance is not that great. You know, mutual funds in general have trouble beating the simplest benchmark. And tactical asset managers, with the exception of some firms, have not done that great. Indeed, one of our webcast students is from First Quadrant, which is one of the leaders in tactical asset allocation. They have a program called Global Tactical Asset Allocation, the same name as my course last year. The student actually does asset allocation for this leading edge firm, and hopefully we can learn from her. But in general, you look at the performance, and indeed, you need to realize this, that, and I hear it a lot, people are saying, well, you're teaching tactical asset allocation, but if you look at the performance of the people claiming to do tactical asset allocation, it's not too good. So what's my response to that? There's a lot of people doing asset management with maybe not all the tools that they should be using. That's fine. It's not the case that everybody out of this course over the years is performing poorly. That's definitely not the case. Okay, so there's various levels of skill. What I hope to deliver to you is the jump on that so you can be in like the top quartile. And in my opinion, you can do that out of this course. Indeed, some people in the past have complained that it seems like assignment number 3, assignment number 4 is so mechanical, just regression this and regression that. And surely this isn't what people do, in asset management. And then they get placed at the firm, and all of a sudden, the week after they're placed, they're running the same models, basically. It's like they're back in 453. And then I get the phone call and say, well, I kind of doubted this would happen, but it has happened. What happened in the classroom is actually useful for what I'm doing as a career. Wow. So I hope that's definitely the case in this course. Indeed, I think you should know that I've already revealed a little bit of information here, is that this is not just an academic pursuit for me. This is the stuff that I've advised people on asset allocation. I've constructed models for firms. I'm advisor to many firms that actually do this. So that, of course, doesn't mean anything. We have to see how it actually works in this course. Okay, so that's kind of like, I wanted to stress kind of the importance of this stuff. And I think this is a really stark example. Let me just briefly talk about protocol. We're going to leave the kind of mechanics of regression-based forecasting to probably lecture 2. It's available on the internet. You can kind of take a look at this. I want to go through just the basics of a regression. I actually want to show you how to set up a regression that will actually provide forecasts like this. I want to show you how to make dynamic coefficients. And I'm going to show you that at a number of different spots in this course. But just let me briefly talk about assignment number 1 and assignment number 2. Assignment number 1 is like the big assignment in the course. It's number 1, but it's due kind of the last day. And it's really up to you what you want to do. Something that interests you. It might be a topic in the course. In the past, a lot of people have actually wanted to do a stock selection exercise. And I've got lots of data, mainly emerging market data. And it turns out that you can develop these models in whatever market and transport them to other markets. And it just so happens a lot easier to work with 200 securities than 14,000 securities. Like, indeed, even when you're working with 200 in Excel, it's going to be painful. Okay, so that data is kind of available for stock selection. But I want you to kind of pick something that you think is interesting. And you can look back on some of the presentations. I remember 3 years ago or something, there were 2 students that made presentations. Basically the talk at the time was the Dow at 7,000 was like ludicrous. It was way overvalued. And both these presentations said, no, the correct value should be 10,000. And it's basically shortly thereafter, we went up to 10. Now we've been stuck there for a while. But it could be basically looking forward. It's up to you. The one thing that you just have to be careful of is this can be stuck on my website. Okay, so it's kind of like it's a quality control mechanism in a way, because your name's on it and you're linked to it potentially for a long time. Okay, so you need to put some effort into that assignment. Okay, it's like public embarrassment. Okay, and I put them all up, no matter how bad they are. It goes up. That's fine. It's just coursework. So think about something that you think is kind of interesting. It could be something from another course. It could be something you see on the syllabus or you want to go into more detail. And get your groups together, talk it over, and make an appointment to see me. And we can, I'll basically tell you if I think that it's a good idea. If I say it's not a good idea, then maybe you can do it anyways. You take some risk. Prove me wrong. Because part of this is taking risk. In my job especially, for research, you've got to take a risk. If you don't take any risk, then you're not going to push the frontier. You have to take risks, and it just means that you're going to make mistakes or something's not going to turn out. Okay, so I've had a number of students take projects that I thought were kind of interesting but risky because I didn't know what was going to happen, and it turned out they didn't get the results they wanted. Which sometimes happens, and that's fine. We post that, and it saves somebody 6 months of work because they could see that in 6 weeks here, we kind of established that didn't work. Okay, so don't be afraid to take risk. Your grade is not determined by whether the strategy works. It's kind of the thought that you put into it and the effort, whether it's logical. Okay, so pick something that you think is interesting. And assignment 2, you've got to get cracking on pretty soon. How many have actually done a mean variance optimization in Excel? Okay, well, it's, how many of you use Solver in Excel? Okay, good. Well, then it's going to be easy. Relatively easy. So just basically pick some asset classes, pick some countries. That's what I usually do. Pick 5 countries. Make sure US is one of them, though it might not say that in the assignment. And you're just going to be looking at the average returns, the volatilities, the covariances, and trying to optimize your portfolio for some level of risk, some level of volatility. Pick out the portfolio weights with the highest expected return. It's a very simple exercise. You need to do it. Everybody has to do it. And then once you actually do it, then we can talk about the problems with it. Okay, but you've got to get cracking on that. And also, there's an exercise to forecast longer-term returns, which I think is kind of a cool exercise. Any questions? Okay, well, 30 seconds early today. We will see you on Thursday.